Hey, how's it going, guys? Welcome back to MentFX. I hope you enjoyed that little intro, but it actually does serve a purpose, and that purpose is going to be part of today's educational video for you guys. Now, I'm going to try and make it as in-depth as I can. However, our last few videos have been very long, so we're probably going to cut it down just a little bit, all right? So, in today's video, I'm going to talk about my week in review, and I'm going to talk about three main trades that played out totally to about 30 RR. Now, again, 30 RR sounds like a lot, and it is a lot, don't get me wrong, but you got to keep in mind that 30 RR that I've achieved was on the lower time frames. It doesn't always happen, not every single week, of course. There are commissions involved, there are losses involved too, so that 30 RR is just profits. Losses probably amounted to about maybe 4 or 5 RR. And always keep in mind, so I actually did some math here just to show you guys because I wanted to make sure you understand. Keep in mind that I also risk 0.2% per trade. So that 0.2% times the 30 RR made this week was about 6 overall percent that was made on the account, right? That's how you can think about it. And at the same time, you know, considering what commissions or spread might have done, that gets prorated and canceled out from that, so you take a little bit out. And there was one, maybe two losses, maybe some break evens that weren't really break evens, but maybe a little bit more losses. So, you know, we're talking about 0.2% losses on some normal losses, so maybe like 2 or 3. You know, maybe we need to double that to be conservative and understand that spread and commissions do affect our bottom line because we are trading a very low time frame. So we'll make that, let's assume, about 10 at the very highest. So maybe we can say 5 to 10 RR is lost in the trenches of spread and commissions. So, you know, that comes out to about 2, and then overall for the week you're still up the 6 minus 2, which is about 4%. So that's like a 20 RR gain for the week, right? So you have the 20 RR of base profit, which, you know, already takes into account all the commissions and the potential losses, and you take that by the 0.2 and you have that 4, right? So this is a very good week for me. I don't always have weeks that are just amazing. Some weeks are just normal break evens. However, this week was great, and this week was entirely on EU. And what I wanted to do today is actually talk about what you saw kind of in the little video right before this video started. So looking at this chart, this is a 4-hour chart. I'm going to make this so you guys can see it right up here because I know that you have the top banner and the bottom banner, making it a little bit harder to see. And I'm going to ask you, where do you think my shorts were in this week? Right, so we'll actually go to a 1 hour in a second, but just taking a look at this, try guess where those shorts were. We're going to draw them all back on in a second, but just try to visualize where they might have been. We'll go to a 1 hour now, and we're going to look at this again. Where do you think those shorts were, right? I mean, I'm sure a lot of you are able to instantly pinpoint this very nice move here and probably are thinking that all the shorts came from there. But lo and behold, this was actually on the 14th of April and before, so that means that was in the previous week, right? So the 14th of April was this week right here, which means now it's the 20th. So we spent it in this week, which means almost all my profits made and all my trades taken, right, were right inside of here and inside of this intermediary structure. Now, as I jump down to a lower time frame, just to make this easier to see, I'm going to break all this down in the mentorship this weekend. It's going to be somewhat of a breakdown in this video today, but I have a few things I wanted to focus on in this video. You'll see some of the trades right here. This was one of my best trades of the week. This was a pretty good trade. I had to close it instantly before spread session because spread session can just take you out. And I had this trade today, which began to run, and then I collapsed it as price started coming back up. And I'll talk about this as well in front of you guys today. But that's basically my week in review, just these 3 shorts, only shorts, right? But the beautiful thing about this, and what I wanted to showcase very quickly before we spoke about anything important, was just noticing that, you know, as we started looking at this, even from a 4-hour perspective, a lot of you might have looked at this and again instantly had your eyes fixated or pinpointed to these very large breakdowns, right? A lot of people envision that if I say something like, I made a lot of money on shorts, or I made a lot of RR on shorts, or my mentorship popped off and everybody killed it on the shorts, a lot of people envision those shorts to have to be where these big black candles exist, right? Or if you're using a different color, you know, a lot of you look at this and basically are envisioning that the only shorts that might have happened are in these huge red candles because that only makes sense that that's where the shorts could have occurred without a thought or relation to where, you know, where we actually moved in terms of liquidity, right? Or in terms of what can happen across time frames. So what's interesting is, you know, for someone that's new, it's very easy to look at this big move here and think that that's where the shorts come from. It's not. And then as we jump down a time frame to the 1 hour even, a lot of people look at this guy right here, which I think is still that 4 hour, and envision that any shorts that might have been had can only be there, and they couldn't even fathom the idea that, you could find 30RR, 10RR, 17RR in tiny areas like this on intermediary structure. You can see my little int markings right here. So ignore all this stuff that's on here. It's for my own brain as I mark up my own charts. I have my own lines for different things. I have my own labelings for different things. I go over these in the mentorship. However, if you haven't been seeing any of my other videos, you definitely should check them out and continue to grow as you watch them. Now that said, right, a lot of people associate that these large moves are where the real moves are coming from, or where that real money is made, when that's never the actual point. And the main thing I want to talk about today was the fact that, you can still find huge RR and great moves and profitable trades, and it doesn't always have to be huge RR, but you're going to find very profitable trades in very mini 3-box setups within larger 3-box setups, right? You're going to find it within these intermediary structure points. Now, intermediary structure, and the reason that it exists, so you'll notice this here, is that it is putting in some form of structure. There are certain pullbacks that are being put in. There are certain manipulations being put in that are taking out potential highs or other highs, right? Liquidating those highs and continuing lower and creating in motion potential displacement worthy 3-box setups that then come back, hit certain supply and demand zones and continue, come up, hit certain supply and demand zones and continue, come up. You can see I was looking for shorts here, maybe hit a supply and demand zone, either continue or in this case fail. But the main thing you need to recognize is that in these moments, this intermediary structure is what I like to call fluff structure, right? It's fake structure. It's liquidity-based structure. And what that means is you need to disassociate from the fact that just because you have some kind of impulse, that it's an impulse that wants to hold price to the downside, right? This is not always the case. Now, when you have a larger time frame structure, so the real structure of this entire, this entire drawing in front of you, or this entire market in front of you at this current point, the snapshot of it, the main structural point is really from this high to this low, or there could be arguments made for this high to this low. That's usually what I would use, just because of the fact that this was a liquidation candle, and that's my pullback that made that low, right? That broke down the structure. So you could call this that break of structure down, and ever since this break of, let's get rid of that. I don't know why that is that color. Ever since this break of structure down right here, right, you've been in this huge bearish cycle, or this very big bearish move that came from this high to this low. And as you know, as I teach it on this channel, this is your protected high, and this is your next potential liquidity, which means all you're really looking for is the supply and demand zones within this overall move down to hold price lower. Now, the most aggressive part of that move, or the last part of that move, would be this one right here, right? That's that last up move before the down move. And then similarly, you can have the inside S&Ds marked up too, and you can see that's where price is hitting. However, there's a higher likelihood that price is coming here to mitigate, just to create some more liquidity before making that run up. Now, again, we can never be sure, but that is probably the case, which is why oftentimes, more than not, in the scenario of a 3-box setup, such as, here's your first box, here's your second box, here's your third box if it gets here, we're looking at the move that's highest up, right? Where's that highest up move before the down move that makes the most sense? So even though this one might be valid, we recognize that it's for the short term. It's an intermediary S&D zone, right? It's an S&D zone that can hold price down for a little bit. Maybe you can find, a good 1 to 30, 1 to 10, whatever in this area here, because again, this is a 1-hour chart, which means in here you're going to have a phenomena of multiple setups, right? You're going to have great setups in there. It's probably something like this on a lower time frame. How do we know that? Just because we understand the market's fractal, right? We can go to that down candle right there. We can jump down to that 1 minute, and clearly, you have a number of setups within there. Now, I'm not going to break all of those setups down, right? But there's a good amount of setups right there, right? That take you lower. That's that proration of this understanding within that 1-hour area, right? And this is also the understanding that allows you to take a market, and when I tell you I went short and made a lot of money, you don't instantly assume that those shorts were made here, right? What you need to realize is, even in the mentorship, right? And I only bring up the mentorship because that's where I see day-to-day people taking trades and, students completely slaughtering the markets. I know that when someone says, this week I took a short and made maybe 1 to 30 on it, it doesn't mean they made it here, right? It doesn't mean they even made it here where I did, or here where I did, right? What it could mean is they had an entry that they found off as per their rules within, let's say, this 3 candles right here, these 3 black candles. And those 3 black candles with the low made right there with that wick could have been the 3 candles that delivered to them perfectly into their given area, right? Maybe they had a lower time frame structure that they had drawn up inside of here, and that structure delivered to this leg right here, and that was their last take profit, right? So you need to disassociate from the fact that just because there's a large down move or large up move like this one, that is where the money needs to be pulled out of, because that's never the case. The money can be pulled out of all the intermediary price action as well, right? And you can find a lot in just one candle if you understand fractals from the way that we are teaching them here. Now, the importance of that first clip you saw was that a lot of traders this week, now again, it's not wrong for you to do this, however, it is wrong if you're forcing certain things. A lot of traders this week, what they did is they took a look at, let's get rid of all of this stuff. Okay, we can't, great, whatever, it's fine. Right, so what happens is a lot of traders this week saw this move down right here, right, from this high to this low. And instantly, what happens is people are on the boat of, well, we have to be long, we have to be long, we have to be long. And a lot of people, as the week opens in or around these areas here, are looking for any reason to go long, right? If we go to a lower time frame here, what you're going to see is from that move up right here, right? A lot of people, a lot of dumb or smart money or dumb institutions, right, are already looking at, you know, maybe an S&D in here, the S&D in here, maybe the one in here, maybe the S&D right here, maybe even something refined inside of here, right? A lot of people are looking to catch the market at any of these support and resistance zones, or these kind of supply and demand zones that are based in nothing, right? They just kind of exist in the market, but they're not supported by any structure. And the reason they're doing that, right, is because they've seen this large move get created. They have their knowledge or consistency of knowing, yeah, this could be an impulse and this could be the protected high, which means in their minds, we need to come up long to come here to go short. We need to come up long to go short. We need to come up long to go short. We need to come up long to go short. We need to come up long to go short. Now, in this case, yes, it hit this, and yes, it went bullish from there. But again, you draw enough lines onto any chart, eventually one of them is going to have some kind of reaction, which doesn't mean that you're right? You know, like, you could have had this drawn in maybe for right here from that refinement, and you could have caught this up, but what would you have been doing at every single one of these points? And if you were using every single one of these points here, by the time price gets right here into the zone, are you now looking to target all the way up here? Or are you sitting there targeting this supply and this supply and this supply and the refinement of that supply and this supply? And when price does get there, right? And when price does get there and begin to, what do we call it? And begin to push off of it, right? Mitigate that area and push off of it. Are you looking to close your positions? Are you collapsing? Are you getting back in? What are you doing? And in that case, you know, once we zoom out, what are you back inside of? What are you starting to see again? You have the striped pajama fallacy, the striped pajama issue. And that issue is something I talk about a lot on this channel, but I'm going to break it down for you right now. The striped pajama issue is when you begin to draw in every single zone you can possibly see with no backing, with no structure under it, with no story to build it up. And what happens is you're just using every single zone to potentially go long, right? And you're using every potential zone to go short. Right? And what happens is, even though you have moves that tap into zones perfectly and go long from them, even though the tap might be perfect in hindsight now, it would never get you anywhere because you have no idea where your targets might be, what targets you actually have, because you're looking at every single zone that exists, and you jump into the striped pajama fallacy where you have every zone highlighted, so something is bound to happen, but you're bound to not catch anything off of it. And this striped pajama fallacy can be seen and basically, you know, and the problem of it can be shown across any time frame or any price action, right? This is the idea that I presented at the very beginning of my channel. So, you know, if you haven't seen my other videos, I really suggest you watch them. But the idea is, you know, if we go to the left here and you just kind of go randomly, right? We can even go to something random like, I don't know, GBP CHF, right? Let's delete all this. Let's just truncate this. Again, this is just for the sake of showing you, right? We go to the left here and we draw this in like that, right? What we can also do simultaneously is we can literally just delete everything, right? And what you can do, right, is you can draw in lines, right? We draw in enough lines just like that, right? Whatever, cool, right? And let's put price back on. Okay, now I don't know how to do that. Is it in settings? Yeah, it is. Okay, great. So we put price back on. Now what's funny is, again, these lines are drawn randomly, and here is where that fallacy or that problem of drawing every zone you possibly can find on, right? What happens is, yes, as we now play price out, you're going to see that these zones have some kind of bearing on price. And to someone that, you know, uses any supply and demand zone that they possibly can draw on, it's going to look like what they're doing is working, but in reality, all it's doing is it's just hitting zones randomly, right? You don't know, like, what, is this a retest? Is this the retest of that again, and now it's going long, right? Is it now testing it, going short? Great, now it breaks out long. Look at that perfect catch, right? These are just randomly drawn. The point is, when you fall into that dumb way of thinking where you literally go into a price and go demand, 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 right? You're just creating that striped pajama fallacy. You're creating the same striped pajama fallacy as you see me drawing here, right? You can also do the same thing and just draw bigger zones, right? Some people do this in retail. They go, all right, here's my zone, here's my zone, here's my zone, right? Again, you're creating that same pajama fallacy where is price actually heading, right? Are you going long here? And if so, are you targeting this? Or are you going long here and you're just waiting now? Or are you now watching this and saying, well, now I have another zone here, right? Now, what are you doing? Where's the line being drawn? Are you going short here? Are you going long here? Are you now shorting off of that retest? As it fails again, do you long here? If you do long here, are you shorting up here? Are you taking profit there? Or are you shorting here? Because if you're not, you're taking a loss here. Are you longing here? Or have you already been long here? Now, are you shorting when it gets here? Are you targeting that? Are you shorting up here? Or are you targeting here? Are you losing? Are you winning? Like, what's happening? And all of a sudden, you have technically, zones that hold, but in reality, right, nothing's really occurring. Like, yes, these demand zones, right, you can see, wow, it held, wow, demand zone hold, wow, demand zone hold. And similarly, you can make that same argument for this right here, right, where I drew that random zone in, where was it? Right here, and said, wow, demand zone held, right? But the reality is, if you had every single one of these drawn up, they all held for some reason, and then as it's going upwards, are you still targeting here? Or are you now targeting supply, 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 supply? And you're falling into that issue. Now, that's an issue, and you don't want to approach it from that area. And the problem with doing that is that even when you have a nice bias like this one right here, instead of just setting a let's say an alert here and waiting now, what people tend to do is say, because we've made this impulse, it only makes sense that price needs to be bullish now. But what they're forgetting is that if you are a trend follower, which we are, basically, we are structure followers, we're the followers of that footprint, then what you need to recognize is at any given point, if you have a certain break of structure or a certain bias, like let's say a short break of structure, boom, you have a short break of structure. The reality is this market is more short than bullish. And the reality is the probability of a pullback is actually less than it pulling back a little bit and going short. Why? Because the short's already in motion. The protected highs and lows are already in motion, which is why I teach you guys from a 3-box setup to have your 3-box, set your alert, and wait for the entry. Don't trade into the entry. You can do this, and this is something that you will do as you excel, as you grow as a trader, but you cannot begin to force that, right? The point of that little video at the very start with the course thing, right, was to recognize that just because price was here at the start of the week doesn't mean it's ready to go bullish. And a lot of people are stuck in the moment or stuck in this range, right? They're stuck in this range, forcing any longs they possibly see to go long. Now, in this case, yes, it worked, but usually it won't. What oftentimes happens, right? All of these sells I had here were sells I was looking to target into this low and continue even lower, right? The reasoning for that is because if the market is showing you that it's bearish, right? Boom, it's bearish. The likelihood of it continuing bearish is much higher, which means as it comes up, the likelihood even from here isn't to go long and hit the zone. It's actually more likely to just go short, right? As it goes shorter, it's more likely to go short instead of come and hit a zone and then go short. Now, when it comes to hit that zone using that 3-box setup, like I teach you, go and check out the rest of my channel, and you guys will learn about that. That is when you want to actually look to get involved. The reality is, once you draw this in, all you should be doing is setting an alert here, setting an alert there, and closing your entire market. You shouldn't be even looking at it, right? This should all just be gone, and you should just be waiting for a little chime on your phone, right? If you're testing this way, because you need to get used to seeing how these ranges develop. The reality is, this price action was more likely at the start of this week to keep going short, right? Even though it didn't here, right? So great, MentFX is wrong. Even though it didn't go short here, the likelihood is that it wants to continue short instead of make this retracement long. And that's an issue a lot of people in the smart money field come across, right? This is where that dumb money comes in. What they're doing is they're forcing any possible longs they can possibly find off of these zones inside of here. Any demand zone they can possibly find, they try to force buys off of, because for them, it needs to go long to mitigate, but it doesn't. It doesn't always need to mitigate. We work on the footprint of smart money. That is why we set our alerts, we set our zones, we have our 3-box setup, and we wait for that tap to then look for confirm. If that tap doesn't happen, the probability of the trend continuing is actually higher than price coming to your zone, right? That's what you need to realize. We need to take a step back and realize that we're playing mathematically. We're waiting for these mathematical edges to play out, and when they hit, that is when we're going to get involved using whatever other math we have, and then we're going to create that edge and facilitate that edge through the use of the beautiful M, the MentFX, or as I like to call, the management, right? The management will basically hold everything together. That's the sun, right? The M is the sun that facilitates the solar system to hold everything together, to hold your entire system together. But just because you have a range created doesn't mean you want to be going long, right? What it means is actually that the shorts are even more prevalent. And to show you examples of that, we can look anywhere to the left, right? You just go a little bit to the left and you notice this, right? You have a bullish structure, right, that comes into here. Then you have the break of structure down. So let's make this more clean, right? You have this break of structure down, right? You have a new high made, structure breaks down. That's broken down now. A lot of people, once again, at the start of this week, are sitting here with their zone drawn in, thinking what? Well, I need to find longs, right? Everyone here is already on a lower time frame in here looking for any longs they can find. And what they're doing at that point, right, is you can go like this if you really want to. You can go to that 1 minute, or let's go 5 minute, just so we can get there without it breaking, right? They're already sitting here going, I want to trade, at the time, maybe when the week started here, they're like, I want to buy this demand, it fails. I want to buy this demand, it fails. I want to buy this demand, never gets there. I want to buy this demand, it's finally there. And a lot of people are forcing buys in these areas, right, when the trend's already short. And just like that video, that little clip you saw at the very beginning as a little joke, when you're forcing longs, it's going short. And when you're forcing shorts, it's going long. Just like here, when the market's already short, you just want to look to position yourself short, whether it be at that area up here if price got there, or at the newly created potential structures that are in here, because these are going to be more likely than these zones holding. And even though these zones might hold for a little bit, they're going to fail down, because the reality is the structure's already bearish. So instead of forcing longs, take a step back and realize that you're already short, right? Realize that the trend has already been moving short, and that the likelihood, even though there is this pullback potentially, price is going to continue short. And that's what you can play off of on a lower time frame if you want to get involved on those lower time frames, right? So price breaks down. Now, similarly, price breaks, what can you do at that point? A lot of people, okay, so let's do this again. Let's do the smart money game, right? You have that structure break, you have a new structure break. A lot of people are sitting there going, okay, this is where I want to sell. So already with that new break of structure, what a lot of people are doing, what a lot of dumb money, and not just retail, right? You got to realize it's not retail. This is also banks, institutions, hedge funds, right? Hedge funds go out of business all the time. Why do you think that is? So it's a poor sense of understanding, but also a poor sense of risk management. So some good stuff. So what a lot of people are doing already is the first up candle they see, because guess what? On a lower time frame, just like I showed you a second ago, that lower time frame candle is potentially some kind of break to the top side. And people are already looking at demand zone, that they want to go long from, because all they're thinking to themselves is, well, we have to mitigate. We have to fucking mitigate. That has to be mitigated. And all they're doing is, I want to go long, because I need to get here before I go short, without recognizing that the more probable move at this given moment is actually still to just continue lower, or small pullback, continue lower. And how do you figure out where that pullback is going to be to, or how do you follow that? Lower time frame structure, wait for it to signal to you, let that composite man show you what's happening, wait for it to signal to you that it's ready to continue going short, or set your alert right there, set your alert down here, and continue to wait, because you're not always going to get these large pullbacks, because these large pullbacks happen for that mini smart money distribution that needs to occur sometimes, and then a move can occur, right? It's not always going to pull back, right? Sometimes you're going to get that break, nice pullback, boom, then you can be long. But once again, as it's going long, if you're forcing to go short to here, you're missing the longs in here. These are all longs, right? Boom. Yes, shorts here would work, hits, goes long. That's fine. But once again, you have to recognize the probability if structure creates, boom, if structure creates some kind of break, the probability of it getting up here is low. If it gets there, great. We can focus on those shorts. However, if price is here, the likelihood isn't that this break is going to hold price up. The likelihood is actually that it's going to re-break back down and continue short because the shorts are already in motion, right? So what you want to do is when you're focusing on the fake structure or the fluff structure or the inside structure of this range, right? So like if we have, here's that leg, here's the range. If we're focusing on the inner structure and it's doing something like this, we shouldn't be much focused on these points here to go long. Instead, we should be focused on the breaks inside, the intermediary breaks, the fake structure breaks right here to go short, And that's exactly what my week just now was on EU. But again, watch this, right? We can play this. Price comes up. Where is it more likely to go? Long into our zone or continue short? Probably short. And if you're getting position short, fantastic. Break short, makes a new SND somewhere up in here. Again, I'm not going to go refine it right now. It's not the time for that. Just showing you the concept in detail so you understand it. Comes up into it, begins to go short. Now it runs the low. Again, a lot of people, I mean, there's no zone here, but let's just wait for a new. Okay, great. So it gets created. Again, creates a zone. I mean, at this point, it probably is going to continue going short. Okay, go short. Great. See if we get a new zone. Waiting. Okay, great. New break. Now again, same thing happens. We have a structure break and we have a zone. A lot of people, once again, are sitting there looking for a way to buy this, right? All these wicks right here, these wicks, this wick, right, are lower time frame structural shifts. And a lot of people are sitting there trying to force these buys on them and all they're getting is stopped out, right? A lot of you might experience this where you look at this, you try to get in here, price comes in, does this, goes right through. A lot of the reason why a lot of this happens is because you're stuck in this motion of thinking where just because you have some kind of structural range, you need to see a pullback. Whereas the reality is you don't. The reality is the probability is that the market's short and it's likely to remain short. So the better version of what you should be doing is looking for that intermediary or inside price action that reshifts bearish and continue that move forward. Right? So once again, even though price is doing this, the likelihood of it isn't to go long until here. It's actually more likely to continue short. And notice how this is already going to affect a lot of people because a lot of people are sitting here, right? Looking at the left going zone, 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 etc. Right? And as they're seeing this, they're like, well, we have to go long from there. We have to go long, right? And this is all dumb money or retail or support resistance based methodology falling apart unless you already have an edge, right? Because what you're looking at, again, is just random points that don't actually serve any purpose anymore since the range that they were once in has already been disqualified and validated and now is going to be ran because the most probabilistic and current movement of price is actually on the short side, and that short side is now delivering, right? And what we want to do is we can get positioned intermediary short rather than forcing any kind of longs, and it should just continue short as so, right? Again, makes that pullback, comes into not even this SND, just comes up, right? Breaks down on structure inside and just breaks down. And again, those intermediary structure shifts are the ones you want to focus on, right? How so? Well, you could do something like this and you could say something like, well, you know, intermediary wise, so here's your normal break of structure. Intermediary wise, we broke this structure right here. You could call that intermediary, maybe make it a different color, right? And then you could highlight the S&D that broke that. Here's your last up move before the down move, right? There it is. You could follow that into the potential. Yeah, you could make it this. Again, this is a little bit weird of a weird area. Maybe we can go lower time frame to make it more understandable. Here you go. Maybe a zone like this, right? And you could say that even though it's an intermediary break, is more likely because the price is already holding short. And the likelihood is that this 3-box system, 1, 2, and then hopefully if we get a Wyckoff confirmation here for 3, is going to take price lower, right? And there you go. And it delivers lower, and then you can hold that through because now you have a higher time frame bearish market basically lining up with everything else instead of having to force every single long you see. And that's exactly what happened this week. And that's exactly why I used that funny little clip. I found it funny. Maybe you didn't. Maybe you hated it. But that's why I found that clip very, very funny at the start because the reality is when you're at this point in the market, a lot of you are sitting there. Now, again, I know this went long. Usually it will continue going short, but bear with me. A lot of you will be sitting there going, I need to force longs. 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 And as you're doing that, you're missing the shorts. all the shorts are present all the way through all of this area, right? And you see the intermediary shifts that occur as a result. Right, let me get rid of this right here. You have these intermediary shifts, and those intermediary shifts are exactly the thing that I was looking to trade. Now, again, mentorship students, I will break down each one of these trades this weekend in the webinar. We have one every Sunday, by the way, for anyone that's watching this. Link is in the description as well as on the screen. So yeah, join up if you want. It's a great place. The community is phenomenal. You don't have to join up. You have more than enough information on the free YouTube to make use of it. If you ever do become very profitable and have a business, though, feel free to join up with a mentorship. That $100 a month becomes a write-off for you on your taxes. So it's a win-win, and you get to surround yourself with people like me and other traders. So, you know, it's up to you how you want to do that. But the reality is, again, because of the fact that we are in this larger move here, the protected high is still here, the overall positioning of smart money is aiming to the short side, because the short side is currently where that range exists, which means that even though there's a pullback that could be had, the probability and the most likely move is still short. So even though we want to see price short from here, the likelihood of it getting there is lower, which means that if you want to be trading or trading with a bias, the bias is still to go short, which means that when price begins to put in motion some kind of nice displacement on the intermediary charts, right? So this is still the hourly chart, but now it's making these inside plays. You can use those to go short, right? Makes that down move. Here's your huge down move. I don't use any of these as a pullback because these are just wicks. It's terrible to use for a pullback. I don't use them. And I have my rules for that in the mentorship as well. You have this SND zone right here, right? You just have it from, you can see the little imbalance here. Therefore, there's an unmitigated point, a supply point there. Supply gets mitigated. Price begins to go short. As it begins to go short, what do you think I was doing? I was looking for the run of this intermediary structure as well as the run of the overall 3 box, which is here, despite the fact that price hasn't made it here. So a lot of you that have been testing the 3 box, right, might have noticed this. Price makes that impulse, but then it doesn't come up here, and then it goes short. Well, guess what? That 3 box allows you to still formulate the bias, and the bias is still to see price go short to this point, because that's where the next liquidity run exists, and that's where the smart money that's positioned with their now protected high wants to take price down to and liquidate, rather than always come up to a zone and then push down. So instead of forcing the longs inside of this area right here, learn to start to visualize and see the intermediary structure shifts, right, to go short. When the market looks like it wants to go super long, like all of you want to see it, just like that Cars movie, when you want to go super right, you'll find yourself turning left. If you're trying to go super long, you're going to find yourself going short. And as a result, what you need to focus on is in a market that's already predetermined to be short by way of its actual structural points. You want to look to then further that positioning and get position short. So as you watch this, right, even here, right, what do you see? Price breaking down, price breaking down, price breaking down, and then it finally breaks up. Now, I did have these areas as longs, but I had them as targets. I didn't actually want to look for longs from them. And you can see I was still shorting. I actually had a really nice short here. I closed out at 1 to 10, which again isn't 10%. 10 RR for me is only about 2% and a little bit less because of commissions and spreads, especially on my other trades that are losses or break evens, right? So that still gets qualified in, right? Sometimes my 0.2 loss might be a 0.4 loss or 0.3 loss just because of how spreads and commissions work. And I have a lot of you asking me that, but just realize that, you know, my normal RR for first partials is always around 1 to 10. So it takes care of that, and that's how I do it. But you can also do this on a higher time frame. So I had these zones marked out on a lower time frame, and I was willing to not go long from them. But what I was looking for is a way to get short. And once again, I had a short up here that I tried to play down with intermediary new structure shifts. Again, these are on lower time frames as well. And I was looking for them to actually continue taking out lows to hit this point here, and then you can see I had this zone here to take out this low as well. Now, none of that happened. The trade ended up closing at around 1 to 10. And then it ran the high, and then it just ran up, and then I stopped really looking for it. I didn't really care. You can see even today, price was long, but overall, because I'm still short and expecting the low to be ran, I look to get position short. Sadly, I had to close this at, I closed it on the close of this candle right here, just due to the double MB happening there. To make it simple on you guys, because I don't teach the MB specifically on the YouTube channel because it goes a lot deeper in the mentorship and it's really hard to teach in one video. You have weak to strong hands, the break of structure higher, right? the trade above the AR, but no displacement, and then you have the AR displacement, right? So the second that displaces, I just got out of that. But again, I was already break even on this, but I got out of that. So no partials on this. I had my first partial set right here, and sadly that missed it by just a little bit, which is fine. I just ended up closing here. So it wasn't a crazy trade, just a 3.55 again, and that's 3.55 of 0.2 minus whatever partials are there. Sorry, 3.55 times 0.2 minus whatever partials are there. So, you know, that's probably a 0.4, maybe 0.3 to a 0.5% secure, right? So again, it's not insane. Yes, the RRs sound great, but because I have a lower win rate, I have to aim at using less risk. And that's just how I prefer to do it. I don't really mind. I don't need to trade to make money anymore, really. You know, I have a variety of businesses and I'm investing in real estate too. So, you know, this is something I now do as part of my accumulation of things that I do. But that said, this is exactly what you're looking for. And again, none of this is financial advice, just so you all know. But the point is, right, recognize that when you have a range that exists, it's more likely to continue delivering that range rather than pulling back up into any area within that range. Now, when it does pull back, that's when your 3-block setup can become active and you can begin to use it. However, in the case that it doesn't, right, you want to be using not every demand zone you find here to go long. Instead, you want to be using the newly formed potential intermediary price action, and this is something you can do as you become more evolved to begin to go short. And those shorts are the ones that are usually going to pay off. Now, again, this is a great example because I was wrong. You can see price did not deliver to the lows. Instead, it actually finally did reject and began to go long. That's fine. It'll happen. Right, maybe when it gets here, I'll start watching it again to see if I want to go short. However, you know, the probability that this was going to continue going short this week is actually higher than it doing what it did here. And even though this is going to happen sometimes, this same kind of stuff is going to be the things that tempt you to divert from your rules, to change what you're doing, right? And you just need to recognize that when you're in a structural narrative, when that structural narrative is putting in a certain formula, right, the odds are that prices, even without pulling back all the way to a zone, is going to continue delivering. It's going to continue delivering. Now, sometimes you're going to get that nice pullback, right? Or that deeper pullback into this zone right here. And again, there's a small discrepancy here as to why this is permitted, even though this looks like a break. I'm not going to talk about that here. This is dealt with in the mentorship, and it goes a lot deeper. So I can't do it. It's just so much hours of time spent trying to explain it. And then you have that delivery lower, right? And as you have that delivery lower, again, it might not pull back here. It just continues, right? But all of these continuations are basically zones that allow for you to potentially get involved in new sells on the inside, because these are still structural points. They're just becoming fluff structure. They're intermediary structure. And the beautiful thing about understanding, so this is, if you're still here, here's a golden nugget. A beautiful thing about understanding this intermediary structure approach is that in the case that you do have intermediary structure like this form over and over again, and then that intermediary structure fails to deliver to the lows and then break structure on the inside, right? So this is not structure breaking here. This is structure breaking when you have an overall point to work with, an overall range. Price begins to create displacement ranges within that are intermediate, not lower time frame, on the same time frame, but intermediate. And then within those intermediary price creations, let me delete all this. Let me go back to the 1 hour. And then within those intermediary price creations right here, you see price then shift above. Now it's showcasing something to you. What it's showcasing is that these prior zones, because remember, when there's an overall real structural shift and a protected high, that's where we enact, or that's where we believe that smart money is protecting their positions. And that's the main positions being protected. These intermediate points are forms of protection of capital, but much, much weaker and less than, right? Which means that when they're intermediary within a protected range, and then they begin to shift, that is your showcase that prior intermediary structure points are now going to act as liquidity. And what I mean by that is because we're in this range and this intermediary structure has now shifted, the prior intermediary protected highs will now act as their own liquidity. And that's where you're going to see these kind of runs. And that's how you can anticipate sometimes when a range is going to make a pullback through those zones, right? So on this break here, you should expect that now it's probably going to run this high, and potentially come up into this supply or the supply up here, right? And then, of course, as it gets to the supply, you can begin to go short like I did. And again, it failed, so it's probably going to continue, I'm guessing, just higher. I don't know anymore. I stopped for the day. It's 1:30 p.m. I usually stop after the New York session, right? But the anticipation is that when you have this fluff structure, this intermediary structure, and that intermediary structure fails to hold through to the actual structural delivery of a protected high, you can then expect it to be ran before price decides to then turn back around and go short, or turn back around and go short. Right, so that's just a little golden nugget that you guys have for yourself if you've stayed this long, because, you know, the average watch time on my videos is not always at the highest, because not everybody is just interested in taking in, you know, a lot of education. But if you're still here, there you go, and you have that now. So remember, intermediary structure, as it shifts, wants to then run the prior intermediary structure. And when you're in a protected high to a protected low, or any structural narrative, the odds of it continuing in that direction are actually higher than it making a retrace. So instead of forcing any given time, any structure break like this to go long, you should be waiting for some intermediary shift to then begin to go short, because it's more likely. And again, you can see this anywhere. Like if we go to a daily right now and just show you this, right? Let's delete everything for 1 second. Let's delete these as well, right? Let's delete this as well. Yep, it's fine. All right, and let's delete this as well. Oops, there we go. Right, so let's just show you this. And again, this is going to happen on any time frame. What's going to happen is when you have these structural breaks, right? So here's a structural break, right? Price comes up to our zone, right? Begins to push away. Great. So this is an example where price comes up and pushes to the zone and then pushes away. Then it breaks structure. Now, again, you could argue that this point came from, you know, this point here and this point here. A lot of people are still looking to go long inside of any of this. These are all structural breaks on 15-minute, 1 hour, 4 hours. And they're looking to go long here without realizing that the most recent break is bearish. Therefore, the market is bearish, and it's more likely to continue bearish rather than change bullish, right? Similarly, it breaks the next structure. Where does that structure break from? Up here, right? Again, what do you think is happening the second this break right here happened? A lot of people, once again, are sitting there hoping and trying to catch any demand zone now that looks long. Everyone here is on a 1 minute waiting for the first break, and they're looking to take it, and it gets traded through. The first 1 minute break, they're looking to take it, and it gets broken through. And then they're like, oh wait, but it's a big Wyckoff. I got to take it here. They try to take it, it goes through, so on and so forth. Why? Because the market's already predominantly bearish, and because it's predominantly bearish, instead of making that pullback, it's more likely now to continue bearish, which means your lower time frame, you should look for a way to synchronize that lower time frame and wait for some kind of 1 minute break up, but then a re-break down, and then look to follow that down. And that's how you create an overall story and allow that story on a higher time frame to mask what you're doing on a lower time frame. And that's how you know, don't stare right too hard, because then you're going to find yourself going left. If you find yourself going short too hard, you're going to find it going long. If you find yourself forcing longs to get back to a zone, you're going to find it goes short and short and short and short. And there you go, right? And then it'll just continue on that move, as it has. Right? The market's predominantly short, it wants to continue short, it's continuing short. The market's predominantly short, it wants to continue short, it's continuing short. The market's predominantly short, it wants to continue short, it's continuing short. The market's predominantly short, it's probably going to, you know, maybe it's coming to this supply zone, maybe this one up here. I'm not going to refine them right now. The market's short, it's predominantly continuing short. And if we get the type of moves we're looking for within those shorts on those lower time frames, those are the shorts that hold a lot more potency and a lot more probability. And then using those, even if they're intermediary, we can look to get involved. And when those intermediary ones fail, we know that that is a call for a potential bigger pullback in the case of just running other intermediary structure before continuing running in our given direction. And if you don't want to do all that and you want to save yourself time, or you don't want to, you know, have to look inside of all of it, what you can do is you can set your alerts, right? So you can have maybe a zone right here and a zone right here for potential shorts. You can set your alert for the next liquidity point, which is under here, so you know when to look back at the chart, and close it forever and don't look at it again until something new happens. Why? Because at this point, price either comes up and hits this, in which case you can look to confirm it. Price comes up and hits this, in which case you can look to confirm it. Again, this is not specifically the zones I'd be looking at. Again, I'm going to be doing my outlook on EU for real this weekend, once again, in the mentorship. So, you know, you can join up and check that out. We have all of them recorded, and you can check them out from the past, and you can begin to catch up and see the evolution of our traders as well as me over time. And that's how you want to follow overall structure. Just realize that when structure makes that shift, it's more likely to continue in that given direction rather than always making a pullback to a given zone. And if you're forcing the longs of any given week from any point you can possibly find, all you're going to be finding is the liquidation of all those zones over and over again. And this is the dumb smart money way of approaching things, and it's never going to be a way that, you know, works for you long term, really. So, you know, don't get into the striped pajama mindset and keep killing it. Thank you so much, guys. I hope you enjoyed it, and I'll see you all in the next video.